There's talk of rules that could fundamentally change how you borrow money, and if you're an investor, you might already be feeling the heat. Many have labeled one of the new 2026 mortgage rule changes as damaging, labeling it the one income, one loan rule. And it's got a lot of people losing their minds. And I'll get into what they're talking about later on in this video. So OSFI, Canada's banking regulator, is constantly analyzing the market and adjusting borrowing rules for today's environment. A representative from OSFI made comments about new rules coming for rental property mortgages. These comments caused a lot of confusion and a lot of backlash online. Frankly, series of different interpretations were born. Many seem to suggest and therefore think it could soon become much harder for regular individuals and small-scale landlords to qualify for residential rental property mortgages. So in this video, we will cover what are the changes being proposed. Is this one income, one mortgage rule a thing? Are the rules really changing that much, or is this all getting blown out of proportion? Hi, I'm Linda, one of the Ragona sisters. With a record amount of mortgages about to renew from historically low rates, many homeowners are already stretched with payments and have high debt ratios. Many mortgage holders are already stressed. And then you go online and you see some viral clips on TikTok or Instagram with people saying in 2026, buying an investment property will be much more difficult. Now, is that true? Not quite exactly. So let's start off with who's OSFI. They're the Office of the Superintendent of Financial Institutions. They're the federal agency that makes sure banks, credit unions, and mortgage lenders don't take stupid risks that could crash the financial system. And this is exactly what they do. They look at new ways to control risk. Their move here is in clarifying how banks should handle income when it comes to rental and investment properties. I'm not going to lie, there's a lot of doom and gloom flooding the pipeline in regards to the new changes coming to mortgage rules in 2026. So much so, recently OSFI released some clarification, and luckily the sky's not falling on the dreams of anyone who hopes to own an investment property or maybe two as part of their long-term financial strategy. OSFI's new rules are actually aimed at banks at the moment, not individual borrowers, as it's laid out today. So they're changing how banks measure and classify mortgages within their overall risk metrics. If more than 50% of the income used to qualify for a mortgage comes from the property's own rental income, then the mortgage must be treated as an income-producing residential real estate. This new classification, it really matters because it's considered riskier than a regular owner-occupied mortgage. For example, if more than 60% of your income used to qualify comes from rent, then that property sits vacant for a few months. The bank sees that as high risk because your ability to make mortgage payments depends heavily on the rental income. And OSFI wants the lenders to price and classify those loans with that in mind because they require banks to keep a bigger financial cushion behind their mortgages. Money set aside just in case things go sideways. Makes sense. That's the hidden ripple effect. That's why this new classification changes. It's not just about rules. It's about how much money the bank can actually put out there in the market. They don't expect these changes to have major impacts overall on qualifying for a rental property. So what does this mean for you? Well, since banks will need to keep a bit more capital in reserve, they might lend less in this category, or likely they'll start charging slightly higher interest rates on rental property mortgages in this category compared to today. Maybe around an extra 0.05% or referred to as 5 basis points, or I've even heard up to 10 basis points. So for some investors right now, this could be right on the edge. That tiny difference could be the make or break factor between qualifying for a property or not. But for most investors, it'll just mean a slightly higher mortgage payment. And eventually, the added cost will trickle down to renters as a slightly higher rent. We still need to see the final policy. But now, let's rewind a bit to March of 2024. OSFI announced a new set of rules focused on what's called the Loan to Income Framework, also known as LTI. This framework caps how many uninsured mortgages a lender can issue where the amount exceeds 4.5 times the borrower's gross income on new uninsured mortgages. Now, this is key. This is a portfolio level cap, not on a borrower. That means the bank, not you, has to make sure that no more than a certain percentage of their mortgages goes above the 4.5 times threshold. Think of it as an internal risk assessment. So does this mean you're blocked if your loan to income is 4.7 times your income, for example? Not necessarily. It means lenders will be more selective with who gets approved in those higher ratios. For example, some institutions could reserve higher loans to income ratios to those with excellent credit, higher down payments, or strong files overall. So for some investors who are already stretched thin, this could mean more documentation, more scrutiny, and possibly slightly higher rates. Although this has already been introduced, this is not a new thing. I'm bringing this up for a reason, and we'll get back to this 4.5 times your income in just a moment. Now, let's talk about this one income, one mortgage idea that's been floating around. Here's a bit more context on the apparent new rule. OSFI's clarified that the same income cannot be used twice to qualify for multiple mortgages. This is not a 100% brand new rule, but what it is it's new that OSFI is locking it in and making it crystal clear. The rule ensures that both large and small lenders now have to follow the same strict standard, which helps prevent any income from being used or reused across properties. Some lenders already implemented this rule. So starting in 2026, this becomes a firm written rule, not just a general principle or a risk management expectation. Now that we got that cleared, let's discuss the changes OSFI is considering potentially tackling for over-leveraged buyers. Right now, the main safeguard for borrowers in Canada is the mortgage stress test. That's still in place. That means you have to qualify at the greater of 5.25% or 2% higher than the actual contract rate for a new mortgage. So even if your lender gives you a 4% rate, for example, you still have to prove you can afford the payments if rates jump to, for example, 6%. It's designed to make sure borrowers can handle future rate increases, but it doesn't address how much total debt you're taking on compared to your income. Now, back to the 4.5 times your income that the institutions are measuring at the current time, news is stirring around that OSFI is considering replacing the current stress test for some mortgages to this loan to income framework, the LTI, which is your 4.5 times your income. The change would put Canada's lending restrictions in line with countries like the UK, which similarly caps mortgages at 4.5 times the borrower's gross annual income on uninsured mortgages. Their thinking goes like this. If someone's loan is 6 or 7 times their income, they're over leveraged no matter what the rate is. Although, like I mentioned, OSFI is testing its loan to income limits right now, I don't see an official post at the borrower level. So for me, I'd say it's speculation at this point. But if you guys have seen this officially, comment below and let me know the official source. I've read that OSFI will evaluate on the institution level how this loan to income could complement or replace the stress test by at least January of 2026. And yes, currently every federally regulated lender like RBC, TD, and BMO have been monitoring how many of their new uninsured mortgages exceed 4.5 times the borrower's income. We'll see. And as of today, it's leaving many wondering, will this loan to income rule actually replace or complement the stress test? Will it make it harder to qualify? Will it cool the market and push Canadians towards smaller, more affordable homes, whatever that means? Or on the other hand, could it do the exact opposite, opening the door for more first-time homebuyers, fueling demand, and leaving the market more open to rate shocks? Because if the loan to income replaces the current stress test, it would primarily focus on income-based affordability rather than stress testing for interest rate hikes. Regardless, be prepared for lenders to potentially scrutinize documentation more closely and refine how they calculate income for mortgage applications, ultimately affecting how much you can borrow. But we saw this coming, didn't we? Either way, one thing's clear, whatever OSFI decides next will shape not just the housing market, but the financial future of every homeowner in Canada. But let's talk about what you can do today to prepare if you're considering a real estate purchase. First, if you're planning to buy soon, talk to your lender or broker now. Get a clear sense of how these proposed rules could impact your borrowing power. Second, if you're relying on rental income or you're thinking about investing, consider how these limits might affect that strategy, because many of these proposed changes are directly going after investors with multiple properties, those taking on too much debt. And finally, keep an eye open for updates, because being informed early means you can adapt before the change hits. Keep watching the market, because staying informed means you can thrive no matter what changes come down the pipeline. We'll be definitely watching the changes. And if you have any questions about the Greater Toronto Area, we would love to hear from you. Until then, stay well, and we'll see you in the next episode. Bye for now.